you are not expected to create deferred tax liability, which is on account of goodwill. I told you, no, a deferred tax liability shall be recognized for all taxable temporary differences, except to the extent that deferred tax liability arises from initial recognition of goodwill or the initial recognition of asset or liability in which in a transaction which is not a business combination, and that the type of transaction affects neither accounting profit nor taxable profit. Remember, I was just referring about the prohibition, no? Same thing. Yeah, deferred tax asset also on the same lines only we do have. Okay. Say, definitely you people would like to know why it is stated and where it is stated. Here it is mentioned a deferred tax liability is not recognized for goodwill since the recognition shall be done through goodwill itself. This is going to result in inflating the goodwill amount and therefore it is not permitted. Correct? Are you clear?
Yes, sir.
Example number 44 and 45. An asset has a carrying amount of 100 and a tax base of 60. A tax rate of 20% would apply if the asset was sold and a tax rate of 30% would apply to other income. The entity recognizes deferred tax liability of rupees 8 if it is expected to sell the asset without further use, or a deferred tax liability of 12 if it is expected to retain the asset and recover its carrying amount through use. So therefore, what rate we are expected to use will be depending upon the intention of the entity in that asset case. If the asset is likely to be sold immediately when they are going in for business combination, deferred tax liability shall be computed on the difference between the two, between 100 and 60, that being 40 by applying 20% rate if it were to be sold. But if it were to be used for generation of income, then it is to be created at the rate of 30%. So you got to be very careful regarding usage of the rate for the creation of deferred tax liability. This is a point that we thought we will just take it up.